Getting that immediate income from dividends feels good, right? But if those dividends don't grow over time, you will have a problem. For that you need companies in your portfolio like we're reviewing today. Broadcom offers a good 2.9% yield, has a 5-year dividend growth rate of 49%, is present in many growing industries and claims that 99% of all internet traffic runs through at least one of their chips. Sure sounds interesting, doesn't it? Let's dive in. A little disclaimer, I do have a position in Broadcom. I first heard about Broadcom when they were trying to acquire Qualcomm, a company that I also own. I didn't really look into the company then and didn't thereafter, until I started researching for a previous video. But what is Broadcom about? Broadcom is a semiconductor company that operates through two segments, semiconductor solutions and infrastructure software. They operate in critical markets such as data centers, networking, software, wireless, storage and more. So it is clear that Broadcom is one of those companies that benefits from the current environment with chip shortages, working from home and the ever increasing demand for data centers and smartphones. All is looking good right now for Broadcom as they are a front runner in many areas. There must be some risk though, don't you think, Tom? Yes, of course. There always are. Good point. Broadcom is a company that keeps growing through acquisitions, and with 36 acquisitions in the last few years they can be labeled as a serial acquirer. But there's always a risk with acquisitions. It may be hard to find a good deal for Broadcom in the current market, or they acquire a company that is not absorbed well, leading to goodwill impairments. Another industry-specific risk to Broadcom when it comes to acquiring businesses is that often it is a lengthy process incurring significant expenses upfront, before Broadcom will even know if the acquisition will pan out. Risk also lies in reliance on a few big customers for their chips and technologies, and a reliance on a few big suppliers as well. Broadcom has big smartphone producers such as Apple as a customer. And of course the fast pace of innovation. What if Broadcom can't keep up with innovation? Why am I telling you all this? Because I believe that in managing these risks lies the power and competitive advantage or moat of Broadcom. We will get back to that in a bit. Tom, can you remind us why a moat or competitive advantage is important? Of course, no problem. A moat and a competitive advantage are basically the same. It means a company, in this case Broadcom, has certain characteristics that make it hard for another company to compete with Broadcom. This protects the profits of a company long term. Some guy named Warren Buffett always looks at what kind of moat a company has to protect its castle, or profits. Broadcom has a couple of moats. They have one of the largest intellectual property portfolios in the industry. This is important because it means other companies can't use that specific technology or part of a technology without paying royalties, protecting their advantage. How important? Important enough for companies to sue because they are seen as too monopolistic. Just ask Qualcomm about their legal battle with Apple, which was over the royalties Apple had to pay to use their patents. Broadcom also has the first mover advantage in many markets. This is important because it allows a company to be the main company in that market before other companies have a chance to compete. This allows Broadcom to have stellar revenue growth, like you can see here. The revenue growth has slowed down a bit in recent years, but Broadcom has found something to combat the implications of that, which we will find out in a bit. An important aspect of first mover advantage is also that margins can typically be higher since you can ask a higher price for your products than you would in a competitive market. Where revenue growth has slowed down a bit, the margins of Broadcom have been expanding. With higher margins, their profits or net income have still risen double digits despite revenue growth slowing down. The other risk that Broadcom faces, as do most tech companies, is becoming obsolete because they cannot keep up with innovation. This often results in cyclicality in profits and free cash flow as well. Broadcom differs from its fellow semiconductors in a crucial way when it comes to keeping up with innovation. Let me first explain how Broadcom operates when it comes to the chip production process. Broadcom is what is called a fabless semiconductor. This means they design and market their chips, but they do not produce them. They leave that up to TSMC, a company I've covered extensively before on this channel as well, which takes away a lot of figuring out how to produce smaller and smaller chips in a cost-effective way. They leave that up to the masters of that process, TSMC. This lowers the capital intensity by a lot for Broadcom, making it less risky when revenue is not growing as fast. Now, Broadcom is definitely not the only one with this business model. In fact, a lot of major semiconductors such as AMD, Nvidia, Qualcomm and so on all leave the production process up to TSMC. Broadcom spent about $5 billion on R&D last year. As a percentage of revenue, this is no impressive feat for a semiconductor at 21%. So again, this does not make them stand out between the others. But Broadcom understands that it can be hard to keep up with innovation if you keep it all in-house, i.e. by your own R&D. So where Broadcom does stand out from its peers is buying themselves into innovation by acquiring companies. Others do that as well, but in the semiconductor industry, no one does it quite like Broadcom. As a serial acquirer, this is part of Broadcom's DNA. Just look at how the company was formed as we know it today. Sure Tom, but other companies have tried to buy their way into innovation and failed. How are you so sure that Broadcom is successful at this? Good point, weird voice, that sounds a lot like me. First, just look at the track record I just showed you. If Broadcom was not good at the acquisition game, they would not have been able to grow their earnings per share or free cash flow per share like this. So how does this connect to the 49% dividend growth you were talking about at the beginning, Tom? It has everything to do with it. You see, without growing earnings and free cash flow per share, dividend growth is not sustainable. The dividends of Broadcom grew from $1.94 per share in annual dividends for 2016 to an estimated $14.40 in 2021, for a compounded annual growth rate of 49%. The free cash flow per share grew by 33% compounded annually, so not as fast but definitely enough to support the dividends. And with a free cash flow payout ratio of about 50%, dividends are well covered. So are the dividends sustainable? Yes, I would definitely say so. I cannot wait until Broadcom announces their next dividend raise, which I expect will be well into the double digits. Great, so all is good, Tom? Well, there are always risks that could also influence future profits and thus future dividend increases. One of those is the cyclicality of the chip industry, as mentioned before, which also causes swings in the stock price, even very recently. But if you can handle those, Broadcom looks good on the dividend growth front and on the current dividend income front with a yield of almost 3%. A very rare combination in today's market. But not so fast. There's usually something to be aware of with companies that acquire a lot of other companies, which could also affect the growth of the dividends. And that is racking up a lot of debt. So let's take a look if this is an issue with Broadcom. The net debt to EBITDA, showing us how many years it would take Broadcom to pay off its debt with their current EBITDA income, a proxy for cash flow, is at 1.67 for the next 12 months. Is this high? Compared to some of its peers like Nvidia, Intel and Qualcomm, it is on the higher side since they all have very little debt. Also, their credit rating at BBB- is lower than most of its peers. Do I think this is an issue? No, because the net debt to EBITDA has actually improved in recent times, and Broadcom is known to mostly use cash for their acquisitions. And with turning about 50% of their revenue into free cash flow, they're very efficient and are able to generate a lot of cash flow. But what about valuation? Is this dividend growth monster on sale? The dividend yield theory says, slightly, with the current yield of almost 3% above the 5-year average of 2.74%. Fastgraph says, definitely yes, based on the orange fair value line, but meh when looking at the historical average of the market. Finbox says, definitely yes. I give Broadcom an upside of almost 17%. Opinions are not unanimous, but at worst Broadcom is at fair value and at best undervalued. Is the future of Broadcom bright enough to skyrocket our dividend income though? In the semiconductor segment of Broadcom's business, Broadcom is successfully targeting industry growth areas such as cloud providers, hyperscale data centers, and so on. The infrastructure software segment is focused on building more strategic relationships with core customers, where those customers are served with a contract involving a broad range of product portfolio. Okay Tom, hard numbers please, we want our dividend income to grow. Alright, analysts on Fastgraphs are expecting a 26% growth rate in 2021 and a 12% growth rate in 2022 to end up with an earnings per share of just above $31. So my guess at this point in time is that we can expect a dividend increase in the high teens announced at the end of this year and also double-digit increases the year after that. Broadcom has surprised analysts to the upside 3 out of the last 5 years and right around par in the last 2 years, meaning that it is likely that these earnings growth numbers will be matched or greater than expected. So with the current 3% yield, those double-digit dividend increases will quickly lead to generous returns and are likely to skyrocket your dividend income. If you're looking for a higher starting income, definitely check out the battle for fat dividends between Omega Healthcare and Medical Properties Trust by clicking on the video to the right.